I had a few questions about my selling puts video, so I thought I would just make a quick video to answer some of those questions because I'm sure several people may have the same question. So the first one is around contract size. When I gave the example with Micron Technologies, and let's just quickly pull up one here. In my case, mine defaults to 10 contracts. But for the example, I just lowered it to 1 because 1 is the minimum contract size you can do. So I just wanted to give an idea of what the credit received was in relation to the buying power. So for one contract, I'm getting paid $52 and I'm having to put up $856 in buying power. But it doesn't have to be one contract. I mean, I could increase this. I could have left it at 10. But obviously, the more contracts you do, the more margin it's going to take up, and you, of course, are going to get paid more credit as well. So by doing 10, now I'm getting paid $520, but it takes $8,500 of buying power. So it really just comes down to the size of your account, how many contracts you're willing to put on. So I think the confusion was on this example, I showed one contract, but then when I gave an example of one of my trades that I actually had put on, I had it showing 8 contracts for this Las Vegas Sands. And so that's just because that's how much I was willing to risk at the time. It doesn't have to be 8. I mean, it could have been 1. That's just how many contracts I wanted to trade. I don't always trade the same number of contracts. It really depends on how much the stock is, how much my buying power is going to take up. You know, I may start at 10 contracts and realize, wow, I don't have enough buying power for 10 contracts, so I will lower it to, 4 or 5 contracts. It just depends. I mean, we can look at another example. Square, I did this earlier in the year. I only did 5 contracts because at the time, for whatever reason, I may not have had enough buying power to do more than that. So I sold 5 contracts and received a 68-cent credit, and then just a few days later I closed it out for 10 cents. So I made about a 58-cent profit on that one times the 5 contracts. So contract size, again, it just it really doesn't matter. It's just whatever you're comfortable with trading. The next question was around, let's go back to LVS, that there was no green closing trades. Like if we go back to Square, it's pretty straightforward. I had a red sell, and then later I had the buy to close it out. But when we look at LVS, you don't really see that. And in my initial video, I didn't have this last trade. This is actually a trade I put on the next day after I made that video, where I did close out this position. As I mentioned in the video, Las Vegas Sands had gone up above my strike, and that I was going to hopefully be able to get out of it, and then I may close it early so that I don't have to hold it till expiration. Well, that's what I did. I closed this on the 10th, and I was able to buy it back for 8 cents and get out of the trade. The reason why you don't see any closing trades prior to this is because I was having to roll every week. And when you roll, technically you're closing it out, but you're reopening that trade at the exact same time. So it doesn't generate a green closing trade because you're closing and opening at the exact same time, which keeps you in the trade. All you're really doing is extending yourself out for 1 week in my case, because I always do these a week at a time. So that's why you never see a close, even though technically I am closing. If you look at this first roll that I had to do, it shows a close and then an open. So hopefully that clears that up, is that there was a closed trade that occurred here, but since the open was part of this trade, it did not generate a green close trade. It still treats this as an open trade because I'm just pushing it out, and the fact that I received a credit for that also is why it's considering this an open trade, because I'm getting a credit for this. If this would have been a closed trade to get out of this trade altogether, then it would have been green. And then also a question was asked about the spread type showing calendar. So when you do a roll, I mean, it technically is a calendar trade. I mean, the definition of a calendar is where you buy and sell an option at the same strike in different expiration periods. That's essentially what I'm doing here. I'm buying the 77 strike and the March 16th expiration, and I'm opening the March 23rd at the 77 strike as well. That's what a calendar is. But this isn't what you would typically think of as a calendar, in the sense that normally when you put on a calendar strategy, when you're trying to put on a calendar trade, they would both be to open. You would be buying to open at that expiration, and you would be selling to open at the other expiration. In this case, I'm closing out this one and opening the next one, so it's still calling this a calendar strategy, but technically that's not what it is. So you can really ignore this. I didn't have to specify this when I put on the trade. It just by default assigned it that name. I guess systemically it's anytime it sees where you have two expirations at the same strike, it just defaults it to say calendar. But you don't really have to worry about the names. If you go back and look at the screenshots I made showing how I actually do a roll, at no point did I have to select this was a calendar. I just selected roll. It automatically will put the two legs in my screen, and I can adjust those if I would like to. Like if I want to adjust the expiration, I can change them in my screenshot or in the rolling order screen. But the spread description really is you don't have to worry about that. Even sometimes it may show diagonal. I can have an example. Yeah, you can see on this MU example, Micron, I had a diagonal. It shows diagonal there, and the reason for that is because when I rolled it, not only did I change the expiration, but I also changed my strikes. I changed it from 43.50 to 42.50. So anytime you change the strikes, it'll show diagonal. And again, that's nothing to really be concerned with. Let's see. Another question I had was around when assignment happens. So that email I showed where I got assigned the shares of Las Vegas Sands on May 3rd. Assignment always happens after hours. Even if the buyer of that option notifies their broker during the day, during trading hours, they want to exercise that option, it doesn't happen right then. All assignment happens overnight, and you'll get notified at some point in the morning. I usually get an email about 2 a.m. letting me know that those shares have been assigned, and when I log into my account that morning, I'll see those shares in my account. So the shares will be in your account the following morning if you get early assigned, so that when the market opens, you can immediately sell those shares if you'd like. Like in this case, I sold my shares. I think I waited till around noon for no particular reason. I may have been busy that morning and just didn't get around to selling them because, again, there's no rush because, as I mentioned before, my broker gives me several days to resolve anytime I have a negative balance. So I didn't rush necessarily to do it immediately first thing in the morning. Another thing to mention about early assignment is completely random. So when you sell a put, whoever it is you're selling that put to, it doesn't necessarily mean it's that exact buyer of your put is the one who exercised their option. It could have been anybody who decided to exercise their option, and they will just randomly assign that stock to someone who has sold that put. So that's just another FYI that it's completely random. If you start seeing that you're getting assigned a lot, you may think, man, all these people I'm selling puts to keep assigning me early. It's a random selection of who gets that assignment. I would say I get early assigned maybe 5% of the time if my stock moves in the money. Usually the deeper in the money it goes, the bigger the chance is you'll get early assigned, because once it goes so deep in the money, there's not a lot of time value left in those options, so there's really no reason why the buyer would need to hold on till expiration, so they may go ahead and early assign you. So just be aware of that. The next question was, how far do I typically go out when I'm selling these puts? I normally just do it a week at a time. I usually on Thursday or Friday, I'll start closing out trades that are going to expire out of the money. Like today, or I'm sorry, yesterday I was closing out this Las Vegas Sands trade. So Thursday and Friday is kind of my cleanup days. I start closing out trades. I'll start rolling trades that I know that are going to be in the money. So I'll go ahead and roll them into the next week. And then whatever margin I have available, I'll start adding new trades. And I usually will just add that trade for the next Friday. Some traders, especially if you follow the Tasty Trade philosophy, they will usually go out a lot further in duration. They'll go out about 45 days, but they won't hold it till expiration. Usually they'll take the trade off about halfway through when you realize about 50% of your profit. So if you sell a put and you receive $1 credit, once it's worth 50 cents, they would go ahead and take that trade off and then free up that margin to put into another trade. And the reason for that is the longer you hold it, the longer you have risk of the stock dropping below your strike price. So they want to get out of it early and then reallocate that margin to a new trade. For me, I don't really follow that rule because since mine are so short term, I'm only in the trade for 5 or 6 days at most. I don't really worry about that. And again, even if it goes below my strike, I know I can always roll it. Now, I don't necessarily always hold the expiration. I try to close out early when I can. In this case, I closed out the Las Vegas Sands a day early because it wasn't worth it to me to hold one extra day, really 2 days, because I closed it out at 10 a.m. So I didn't want to hold it all day Thursday and then Friday just to make another 8 cents. It just doesn't make sense to me. So if I have those situations, I think I had another one with MU. When was this? Yeah, you can see on May the 4th, that would have been a Friday, I sold 10 contracts and got paid 61 cents. Well, that following Monday, on the 7th, Micron had shot up a good bit to where that option dropped to 18 cents. So I went ahead and got out of it. I saw no need to hold this option all the way to May 11th just to make the remaining 18 cents. I mean, I've already really made a good profit on that. So I went ahead and closed it out. So I don't always hold till expiration. It really just depends on where the stock is, how do I feel it's going to trade over the next few days. But long story short, the answer to that question is I always trade a week at a time. I don't normally go longer than that. If I do, it's very rare. And I think that was all the questions. So if there's any other questions you have, just let me know and I can make another update video. Thanks.